Hello guys, and welcome back to another video. In this video, we will be going through a concept called mitigation. Now, what is mitigation? It's completely the mitigation is a process that comes after the order block is created. But till now, we have seen that, you know what happens when the order block is created. We know, and when we have a down candle before an up move, we have an impulse serve more breaking a structure, then we have a bullish order block also called as the demand, and then we have a down move breaking a structure the last up candle before the down move. That order block is a base order block, and that's called the supply. Now we know this up candle before down, move the down candle before up move, are order blocks. But why are these called order blocks? So what exactly is an order block, or how is it created, and why it's so important? That's what we'll learn in the mitigation. And mitigation is a process where the price comes back to the order block. So why the price is coming back to the order block? Okay, so you see, on the order block is created, prices come back to the order block. We know when you have imbalance, price also comes back to the order block. So what is the reason why the price is coming back to the order block, and why we always take the opposite candle before the move? And why is that called the order block? That's all we'll be looking into this mitigation. So let's get through directly on our drawing board, and let me explain you what is mitigation, and then we will get on the chart to further show you some examples. So now let's get into it. And now let's understand what is a mitigation and why it's so important. So till now, what we have seen that when we have a range, what the bank does, we have a range here. Of course, below the range, people stop losses are there here who are buying above the support people, thinking this is support, and they are buying here. Okay? So people who are buying here have their stop loss just below the support. Okay? Because here, we have a lot of liquidity before below this support. Now, what will happen? How the bank places their order? We have already learned the bank comes down, takes the liquidity, the people stop loss, and then moves up, right? So how they're coming down because everybody's already buying here? What happens if they can't just simply go down? Number. What happens is they initially open some sell orders to go below the support. Okay? So this is where they are opening sell orders to break the support and go below. So once they are below the support, they have access to people stop losses, right? So they have access to people's stop losses. So this is where they're opening some sell orders to go below the support. And then once they are here, now, they will use people's stop losses, which are sell orders here, and place their buy orders and the price moves up, right? So this is perfect, right? So if they are first selling to get to the point where the liquidity is, and then they are grabbing the liquidity and filling their buy orders and market pushes up. So here now, let's understand, okay, till now it's very simple, right? We had a support, they went down, grabbed people's stop losses and they went down, okay? And now something really important to understand that here, at this particular point, the buy orders that they are placed in this move are running a huge profit. You know they bought here in this level, and now the market is at this level. Of course, they are in huge profit on their buy positions. But what about the sell position that they opened here? Of course, in this move, they have opened their sell orders, which are still opened, and these sell orders are running in loss. Because these are sell orders, they will be in only profit if the market goes down. But they are running in loss. So they are in loss when the market is at the top. And they cannot, just keep going up. I know, because if they keep going up, the sell orders will just increase the loss. So what they want to do before going up further, they want to close these sell orders. They want to close the sell orders in no loss, basically at zero, okay, without any loss. So what they have to do, they will have to bring the price back to the same area where the sell orders open. So they open sell orders in this range, which is our order block. That's why this is called an order block. So order block is basically where they are opening the sell orders before the up move. That's the reason why we take the last down candle before the up move, okay? So why we take the last down candle before the up move? Because they were selling in this candle to get to the point where the liquidity is, then they are buying here. So of course, this sell candle has all their opposite orders. So they will come back to this order block range, close to close, their sell orders. And then from there, they continue to move clear. This is what mitigation means. Okay, so now let me show you something on the presentation. So here you see what happens. They have a range. They have liquidity. So what they are doing, banks initially sold to push price down so that they can grab all liquidity. So they are selling to push the price down, okay? And then what they are doing, they are buying, okay? So at this point, they have their both buy orders and sell orders running. So yeah, they are buying and they're selling. So both are running. So since the market has come up, the buy orders are running in huge profit, but the sell orders are in huge loss. So to close these sell orders, they drive the price back to the order block zone, basically the demand zone. That's called a mitigation move. So this is what mitigation means. So when we create an order block, price comes back to the order block. That's what exactly mitigation means. Okay, now let me show you on the chart as well, so you'll see here. Let's see if you see some examples of mitigation. So see this move. This move went down, breaking a previous structure, right? But we have this as a structure because when you create a higher high, higher low, higher high, so this is a structure, of course, okay? So this structure was broken by this impulsive down. So what does that mean? We have and supply the last up candle before the down move is your supply, okay? So why we take the last up candle? Because they moved up to grab some liquidity. Now, of course, sometimes you may not see which liquidity have been grabbed. There's no visible signs here. But of course, some liquidity have been grabbed in the lower time frame which may not be visible. So we are not really focused on which liquidity have been grabbed. What we want, that we want an impulse removed. Breaking a structure with imbalance. That's it. When you have that, you have your supply the last up candle. So you know why we take up candle? Because this is where they have moved up to grab the liquidity pushing down. So of course, this up candle has their opposite orders, so where they will come now to close before continuing down. So you see, this was our supply, and you see market comes back to the supply. They mitigate the supply and pushes down again. Clear. So what happens? This is the mitigation. So when the price have created the supply by making impulsive move, they will drive the price back to the supply. Okay, so and then they will continue the original move is downside. You see this how the supply was created by moving down, so they will come back and then again move down, okay? This is called the coming back, is called mitigation. Now you see, again, the same thing. You move here again, the same thing. So now this is your supply. Now here the liquidity have been clearly visible. So we see we have an impulsive move to the downside, breaking a previous low, okay? So you see an impulsive move. Of course, you also have imbalance. You see this candle. So imbalances here, then a little imbalance here, then again, imbalances here. You see we have a lot of imbalance in this move. That means a very strong order block here. The last of candle. Of course, why the last of candle? Because you see here the last up candle went up to grab liquidity from these highs. Okay, so this is high, and you see a lot of the 4 candles are there, the market went up, grabbed all the stop losses here, and then pushed down. So this up candle has the bank's order, so they will have to come back to this range of this up candle. But you see, they're coming back here. This is called mitigation. They're coming back and then continue down clear. So this process of coming back is called mitigation. So once the supply or demand is created, price will drive back to the order block. That's so important here. Now let's see more and more examples here, and not every time the price will come here, you see we have a supply here. Okay, the price goes down, breaks a structure, we have supply. But here the price doesn't comes. Not every time the price will come, we also another impulsive move breaking a structure. The last up candle here is your supply. You can just take the whole area. And the move that comes back is called supply, and the mitigation again, there is no more returning back again. You see here that we have an impulse remove, breaking a previous structure. So this structure, this one, was broken by this particular down move. Okay, so the last up candle, including the wick also. So this up candle, including the whole, because this is the whole up price. This is hold your supply area. Or you can just take the wick, because the wick is the up move before the down, the wick in and down. Bearish candle is basically an up move. A wick in a bullish candle is basically down. So this was an up move, taking some liquidity from these highs. Okay, people who are selling here, have they stop loss somewhere in this range? They went up, took the liquidity, and broke down. So this move created the supply. And now, what you can clearly see here, the price comes back to the supply before going down. This is called mitigation. Situation. This is not mitigation, this is continuation. The mitigation is price, returning back to the supply or demand from where it originally started. So it drives back to the order block or the supply, and then continues the move. It again goes down. Let's again check more and more examples here. We have many small supplies here, but let's focus for some good supplies for now. Yeah, here as well as you can in the example. Also, we saw that, we have an impulsive move breaking this structure. The last up candle is here. What we can see, price comes back to the order block supply and then continues down. Okay, so VCM, we have seen multiple examples for supply. Now, let's look for some examples on demand as well. Yep. So we haven't moved to the upside. Breaking the structure, you can see the last down candle is your demand. Why the last down candle? Because this is the candle that went down to grab some liquidity before pushing the price up. So this candle has the bank's orders. That's the only reason we always take the opposite candle from the move, and the price drives back, mitigates, goes up. Okay? Sometimes it can come here and go up. Sometime it can come to 50% and then go up. Or it can even come to 80% and go up. Okay, there's no fixed rule. What we want is the order block is getting mitigated. That's it. Okay. And now you see here also that we have the same case and bullish up, move breaking the structure here. The last down candle is not this one. People will confuse. This is the last down candle. No, before the move. The down candle is here. This is the down candle before that up move. So this is your demand. This down candle is your demand. You see, the price comes back, mitigates the order block or the demand, and then pushes price to back. So this is what we have learned till now. We have an impulsimo breaking a structure with imbalance. Okay? If that happens, then the price will come back to mitigate the demand and then continue the move. I hope that's very clear. Now you have to do some back testing on this thing. Let's take more and more example if I can find, there are actually many examples here, but the market was very choppy here, so we don't take anything. Let me see. Of course, you can see a lot of example, tons of example here. Let me show you. Okay. As you can see, we have a bullish move place. Move to the downside, breaking this structure. Okay, so the last of candle is this one. I told you, when you have the wick along with you can just take the wick also, but this wick is your supply. What you can see, the price comes back at this particular area, mitigates, and then pushes down, right? Okay, so this is why the supply and demand are so important, because that's where the price gets mitigated. Now, more and more example. As you can see, an impulsive move here, breaking a structure here, the last up candle is your supply. Or you can see the price comes back, mitigates and pushes down. Okay? And then you see we have impulsive move to the downside, breaking a lot of structure this one, all the structures, the last of candles, all this area. So, or you can see price exactly comes back the dot in this particular supply, small supply, and then breaks down, okay? So everything. So this is why mitigation is so important. When you have a supply and demand created, price pushes back to that soon. That's called mitigation. And you see here also we have the example. We are an impulsive move. Of course, that's breaking small structure, but it's still the structure break. And we are the last of candle as the order block cause demand supply. Price comes back, mitigates goes down. Let me see if we can find some more examples. Of course, here as well, the demand example and impulse move to the upside, breaking a lot of structures. Here. The last up, the last down candle is this one. Price comes back, mitigates, the demand pushes up. Okay, so the price that's returning back to the demand or supply is called mitigation. So now just go on the chart. Take any pair and take any time frame. Doesn't matter. Do some testing. Find order block or find a demand supply that creates an impulse move, breaking some structure. Also, that move should have imbalance. So find those move and see how the price is coming back and then continuing or not. Okay? So try to find this, and with this, we will wrap this video and I will see you in the next video. Thank you.